Thank you everybody for being here. My name is Paul Hitchcock. If you don't know me, I'm here with the founder and senior managing partner of Barth Calderon LLP, Harry Barth. And a couple things I want to mention up front is I'm going to put a link now into the chat. If there are any questions that come up that you want to get one-on-one with the team on to get answered, anything that starts motivating you based on what we're talking about today, or anything related to asset protection or estate planning, click on the link I'm going to provide, and you can then fill out a form and we will get you booked with the team. And Harry, get it in there. All right, I just put it up there. So we're going to dive right in. Harry, what do we need to know about what's going on with Biden?
Oh, okay. So it's basically what's going on with the government. And so a little background. I think it's very important to take my overall take on what's happening. First of all, remember the power to tax is the power to destroy. And we also have to remember we have to think very importantly about the Biden administration's philosophy. Their philosophy is to increase the tax as best as they possibly can on wealthy Americans. There's a negative bias against anyone who has received their or does receive their assets or their wealth via inheritance or by investment. So the bias is in favor of the wage earner. It's and this is very accurate. And they want to reward work and wages and not inheritances and wealth. And for years, from the Obama administration up through now, they have attempted to change the dynamic of our tax system quite dramatically. So far, the vast majority of the proposals, which we're going to go over again today, as they were just re-released by the Biden administration, something what they call the Green Book, which is the executive branch's proposal for changes. And I have the changes, and we'll talk about them. But I think it's important to understand that maybe some of these will get enacted, maybe some of these will not get enacted, maybe all of them will get enacted, or none of them will get enacted. So we have a long way to travel as far as that's concerned, but we also have to remember we have next year, believe it or not, another presidential election. And
Yeah,
the
amazing.
outcome, and they say that elections have consequences. And I think in this area, they're quite significant. So what we're going to look at today are the proposed changes, which have been constantly repetitive for the last three revenue proposals. And some of them may have some opportunity to become law, and some will come law automatically on December 31st, 2025,
Hmm.
effective January 1st, 2026. And some of them may become law depending upon what happens in the 2024 election. So, if in the 2024 election we have Democrats in the White House, and we have a filibuster-proof a Democratic Senate, which we have a Democratic Senate now, and only a razor-thin majority in the House, one small change or a few small changes there can lead to the things that we're about to discuss today. So, one thing that's very important for everybody that's listening is that right now, as we sit, we have runway. We have time to implement tremendous policies, procedures, changes, trusts, and various different tools and techniques, which will allow us to take advantage of quite a favorable tax environment that we set right now and not wait till the last minute where it might not happen or a retroactive governmental change.
Or even Harry, the runways even to what's going to happen for sure, what you mentioned, what you're going to talk about.
Yeah, the runway we have is until pretty much the end of this year.
Hmm.
And then once again, things could become in jeopardy. So let's talk a little bit about what those proposals are. We'll be very specific today as I go through them with you, and hopefully take some notes, and hopefully most of it won't happen. But we'll start with basically income tax rates. Right now, the top income tax rate federally, and we're only dealing with federal taxes today, not state taxes, is 37%. Under the Biden proposal, beginning in 2023, 2023, this year, they proposed to increase the top rate to 39.6%. So again, believe it or not, a significant increase. But the other thing that's interesting is that on December 31st, 2025, when the Trump era tax cuts expire, the tax rate will revert to 39.6, but it's 39.6 above everything above $647,000 for married couple, $539,000 for single. Under the Biden proposal, it would be 39.6% of everything over $400,000 for single and $450,000 for married. So broad brush, basic income tax increase effective for 2023. The next proposal, which is significant, is very, very significant, is they propose to change the tax rate on qualified dividends and long-term capital gains. Right now, the federal government, the tax rate on qualified dividends and long-term capital gains is 20%. They have been hell-bent on changing that. And in the proposal, in the administration's proposal, again, which we hope never becomes law, they want to tax long-term qualified dividends and long-term capital gains at the same rate as ordinary income, meaning a capital gains tax would be not 20%, but 39.6%.
Huge.
The tax rate on qualified dividends that we receive from stocks and bonds, instead of 20%, 39.6%. So if a taxpayer's income, they're saying, is over $1 million, then they would tax the long-term capital gains and the qualified dividends at the ordinary income tax rate. Now, how does that come in? You say, well, $1 million, it seems like an awful lot of income. Think about our clients that are having an equity event. They're selling a business. They sold their business, they sold their partnership interest, they sold a piece of real estate. And now their income is way over $1 million in that particular year. And that makes that entire equity event subject to ordinary income taxes.
Interesting.
And that could be absolutely horrible. The next proposal that they have is that under current law, when there's a gift, the recipient of the gift takes the donor's carryover basis. However, in the event of death, one of the most powerful tools that we have under American tax law is that the capital basis of assets are stepped up to the fair market value on the date of death. So, for example, if some parents had some property that they bought for $400,000, there's now worth $1 million. God, they die, then the children inherit that. They would have $1 million of basis. So the basis would step up to $1 million. So if they sold it the next day, there would be no capital gains tax. The administration proposes to treat transfers of appreciated property by gift or by death as realization events, meaning that at that point, if I inherited a house for $1 million from my parents that they paid $400,000 for, that I would have to pay capital gains tax on that $600,000. Just a realization event, even though it's not sold, or if it's by a gift. If I gift a property to my children, or you give property to your children, that's a realization event, and we have to pay capital gains on that appreciation. That is a significant change in the landscape for all tax planning. And remember that what I said previously, that the tax rate on that, if it clicks in over $1 million, is 39.6%. If you're in California, tack on another 13%, and that's not including, the tax on passive income or even Medicare tax. So we're going to get into that in a moment. And then the other thing that happens is that for assets that are in trust, were held in partnerships every 90 years. 90 years. It seems like a long time, but they're going retroactive to December 31st, yeah, 1942. So the first time this would happen would be December 31st, 2032. They're doing something what they want to call mark to market, which means that if a property was bought for $100,000 in 1942, and that property is now worth $10 million, it's been held in trust for all that period of time. On the 90th year, on December 31st, 2032, we'd have to pay the gains tax on the
Jeez.
$9,990,000 every 90 years. So they're really, really hell bent on making transfers, any transfers, recognition events. You
Right.
transfer it, you're going to have to pay the tax on that transfer, which is really a very important part of asset protection, estate planning, and income tax planning to take advantage of those rules that we currently have. Again, let's hope that not enacted. They've proposed this before 2 times, and it wasn't enacted. My concern is
Why
that
do
the
they
third,
keep going? Yeah, why do they keep going?
because they don't have the votes. But if they get the votes in 24, this is what we'll see. But we know what we can do in 23 to help protect people. Hence the reason for this emergency webinar that I'm doing today. Another thing to realize is that right now, the other tools that we use are we make transfers to charitable trust, charitable remainder unit trust, charitable lead trust to help offset um, capital gains on appreciated property. Under the administration's proposal, a transfer to a charitable trust would also be a realization event, and we would have to pay a tax on that. And the only deduction that we would get, or the part that's excluded, would be the amount that's not going to a charity. So in most cases, 10% winds up going to charity. So we'd only get a 10% exclusion, 90% would be subject to tax, which effectively would kill much of the benefit of philanthropic gifting through trust for the benefit of charities. So that's also another proposal. Another proposal is that right now, as you know, we have approximately $24 million for a married couple, $12 million for a single person that is exempt from federal transfer or state taxes and or gift taxes. And the rate of taxation is 40% of everything above that. Of course, we have lots of opportunities to help mitigate that through the various different tools and techniques that we use.
Freeze techniques are you talking about?
There's freeze techniques, there's sale techniques, there's risk transfer techniques. There are many techniques that in dealing with the estate taxes. But what's important to understand is under the administration's proposals is that they want to drop that exemption down to $5 million per person, and then index that for inflation starting at the end of the year of 2023. So for persons dying after December 31st, 2023, they want to bring it down to $5 million apiece. Now, of course, we have to understand that um, that happens pretty much automatically on December 31st, 2025. So it's just an acceleration to the year 2024. So even if we don't get in action because they don't have the votes because of the slim majority in the House that are controlled by the Republicans, the election in 2024 can change that landscape. And we also have the autopilot change happening
Hmm.
in 2025. Again, opportunity to do some planning and try to capitalize on the landscape that we have now. Now, one of the things that they talked about, which we don't have now, which I think is a benefit, there are very few benefits, is that the estate tax on certain family-owned businesses and farms, family-operated business would be deferred until the interest in the business is sold or ceases to be a family-owned business and operated. So right now, on a family business, we still have to pay the estate tax in 9 months. That would be a deferral, and the tax on appreciated assets, other than illiquid assets, could be payable over 15 years. So they're making the estate tax much, much more draconian. You're still paying and it's destroying everything, but they're making it a little easier in which to pay them. One of the proposals, which is now we've heard a lot about it in the press, and I want to chat with you a little bit about it today, Paul, and our constituency, is the proposal of a wealth tax. So what the administration has proposed is as follows. Now, understand when I tell you this, we've got to look at the ramifications. We have never had a wealth tax in the history of the United States of America. Matter of fact, my best legal opinion is that a wealth tax is unconstitutional. We have the power, federal government has the power to tax income, but a wealth tax is a tax on gain, the way they're proposing it, whether that gain is realized or unrealized. Now, it starts by saying, and I'll read you the exact thing out of the Green Book. It says the administration proposes to impose a minimum tax of 25% on total income, including unrealized capital gain, on taxpayers with wealth over $100 million. So if you have, now, even though it sounds like 100 million, a lot of money, it's 100 million and it gets lowered to 50 million, then it gets lowered to 25 million because they open the door. We've never had a wealth tax. So if there's over $100 million worth of worth, the unrealized gain, so a business that was started with, $1 million that's now worth $50 million, the business has grown. That's 49 million of unrealized gain. The business is not sold. They want to tax that 25% of that, a 25% tax on that. And then they say, whoopee, they'll give you 9 years to pay it. Where do we get the money? And not only that, that opens the door every year for valuing all of our assets to see whether or not we have made that $100 million or $50 million or $25 million threshold. The cost, just the cost alone of trying to comply with that system is absolutely ridiculous. So my best guess is that the lack of constitutionality, the cost of administering it, and just the destructive power of that in this country is that it will not be enacted. But think, here are our top politicians proposing that, a full frontal attack on wealth in America and our capitalistic system. So let's continue on a little bit. And that would be effective starting in 2024. So really interesting. Another thing too is that one of the tools that we use, and this one is important in estate planning, is something called a grantor retained annuity trust. And what a grantor retained annuity trust does, it allows us to kind of gift assets to the next generation. And if structured properly, I can make a gift to you, Paul, in a grantor retained annuity trust, take back an annuity from it, and if structured properly, there is no gift tax at all. In other words, I make this gift, but I take back an annuity equal to the value of the gift. So it's called what they call a zeroed out GRAT. And a zeroed out GRAT, then if the rate of return or the appreciation on the assets inside this particular trust is greater than the federal threshold rate, I'm able to pass those assets and income on those assets tax-free to the next generation. This has been a bug in the congressional claw for a while. And under the new proposals that are out there today, they want to make it that a GRAT must last at least 10 years, and it must have at least 25% of its value to be used up to gift tax exemption. It would not allow annuity payments to change. And so and no tax-free exchanges would be allowed. So the net effect is to severely impact one of the greater estate planning tools that we have, a grantor retained annuity trust.
And Harry, is that used for primarily businesses, a transfer of a business?
It's used transferably for appreciating assets. It could be stock that you have. A lot of it's used in stock, and a lot of it is used in people that have restricted stock, venture capital stock, and so they make a gift of that and try to get the appreciation to the next generation. The other thing too that is under attack is grantor trust. Now, grantor trust are tools that we use every single day of the week, which allow us to basically create a trust that's a completed gift for gift tax purposes, and all the appreciation would be out of the estate. But it's a grantor trust, meaning that the income tax on those assets are back to the person that created the trust. Kind of a split that's done. And it's very, very helpful in so many ways. It allows transactions to happen between trusts, allows the appreciation of the assets to move without it being a taxable event. So inherently, under the new administration's proposals, any transfer to a trust that's not a fully revocable trust, like our standard living revocable trust
Yeah.
that we use for estate planning, any transfer to a trust that's irrevocable will be considered a realization event. So we'd have to pay tax on the transfer, and the tax would be taxable to the trust at the higher trust rates.
Mhm.
So inherently, they would want to go after grantor trust. Now that could also have a very significant negative impact on the use of life insurance trusts. A lot of people buy life insurance to help pay for the estate taxes. It's a
Right.
very good way to transfer that burden to a third party insurance company. And and one of the reasons that that works is because it's a grantor trust. And the proposal would be some challenges to using a life insurance trust to help pay estate taxes, because otherwise life insurance would also be subject to estate tax. So the insurance lobby is pretty strong. I also don't think that this may get, or the grantor trust rules may change, but I do believe that what's going to happen is there may be a carve out for life insurance trust to some degree and make that work.
Oh, Harry, I want to mention too, because we've had quite a few more people jump on. As I mentioned this early on, there is a link in the chat. If you want to get one-on-one with Harry and the team, complimentary input on your own situation, on any of the issues that are coming up, or you have something else, click on the link, fill out a brief form, and we'll get you connected.
Right. So let's continue on with the full frontal attack on the wealthy. It is a full frontal attack on the wealthy. Um, and the closest we came to passing something very similar to all this was a few years ago. But for Kristen Sinema and Joel Manchin in the Senate, it didn't pass. So it was just, we're talking razor thin margins.
Right.
And I repeat, I don't want to be redundant, but I repeat, there's planning opportunities now to lock in one of the most favorable tax environments that you can ever possibly imagine. You can't wait to the last minute. We have the time to do it now. Please give us an opportunity to at least review this with you.
And Harry, by that you mean that there's strategies you lock in now that even if any changes happen, you're going to be
Yes.
grandfathered in.
Yes,
sort of
there's
thing?
some, yeah, that's correct. Now, in addition, one of the other major things that are utilized for estate tax planning, which is very, very important to the wealthy, is the use of what we call valuation discounts. So if I give you, Paul, $1, you have full dominion and control over that dollar. And so that dollar is worth $1. If I give you $1 worth of Harry's limited partnership, which is controlled by a general partner, under the law, the way it is now, there are discounts in valuing that. So there's a discount for lack of marketability because you can't sell it, you can't
Oh,
do
right.
anything with it.
Right.
And there's a discount for liquidity, and there's a discount for lack of managerial control. Those discounts range anywhere from 20% up to 40%, in that range, some higher, some lower, in the valuation of assets for federal estate tax purposes. So someone with $100 million estate, through proper structuring, the valuation of that estate may come in at $65 million. That's $35 million less because of these discounts, and a saving of close to, 14, $15 million worth of taxes.
Big number. Yeah.
It's a very, very big number. And for people of wealth, the valuation discounts are more valuable than the exemptions. Now, remember, they're going to push those exemptions down to $5 million a person rather than $12 million a person. And what they want to do is inherently take away on intra-family all valuation discounts. So everything would have to be valued at fair market value. That alone
Hmm.
could be a 30% increase, a 40% increase in estate taxation, combined with the very difficult time to use life insurance to pay for it, and a very difficult time because of the lower exemptions. And you ask yourself, well, what's behind all this? What is this attack about? And this is quite significant. People stay up at night and think about all these various different things. And I think philosophically, they feel, or a certain percentage of the government, and even percent of the population, believe that this is good for America. That wealth concentrating in the hands of a smaller number of families is not good for America. But this smaller number of families employ tons and tons of people, and provide a significant boost to the economy. But they believe that the best way to deal with this is the destruction of their wealth as it moves from generation to generation. And hence we see the proposals that we have. So therefore, kind of a redistribution of wealth. And I'm not so sure how that builds in with incentives. So a few other things that are coming about, just to talk about from an administrative point of view. So for example, trusts don't have to report their assets. They have to report their income, but don't
Hmm. Hmm.
necessarily have to report what's in them to the federal government. It's at
Um,
least a spot of privacy where the assets, we turn around and we talk about the fair market value of assets. We talk about the income, dividends, and gains, which we have to pay taxes on or pass through. But we don't have to kind of give a balance sheet on trusts to the government. We do on the businesses. On businesses, there's a balance sheet that's built right into the tax returns, but we don't have to on trusts. Under the new proposed administration proposals, guess what? If a trust has a value of over $300,000 or gross income of over $10,000, which is pretty much every trust, every single trust will have to report the value of their assets to the federal government. And we specifically what's inside the trust. Wow. Then another one. Hate to be, they'll say the Greeks, don't kill the messenger if you don't like the messages. These are the actual proposed tax increases in the Green Book of the Biden administration. And next one has to do with annual gifts. We all can give away annual gifts. And we could do $17,000 a person of present value gifts to any number of individuals. I can give $17,000 to each of my grandchildren. My wife can give $17,000 a year to each of my grandchildren. Matter of fact, we can help pay mortgages. We can help support a parent. We do lots of things with the $17,000 a year, and it's unlimited what we can do. And it doesn't come off our $12 million gift tax exclusion. So under the new proposals that we currently have, the maximum aggregate total that we can give away without the imposition of gift tax or filing a gift tax return would be $50,000 a year in total.
Hmm.
So I could do 50,000, my wife could do 50,000, not 17,000 per person. 50,000 is total. Anything above 50,000 starts to come off the $12 million. We also have the GST exemption. One of the proposals is that every 50 years, or case of partnerships and businesses every 90 years, we have to turn around and pay tax on that. Some states have eliminated the rule against perpetuities. Trusts can last 1,000 years or forever, but that they want that to stop nationally. So at least every 50 years, or / depending on the circumstances, every 90 years, they'll be subject to transfer taxation and break those down.
Mm-hmm.
So there are a few other tax increases. There is a 3.8% tax on net investment passive income. And under the proposal, that's being raised to 5%. There is also a 2.9% tax, Medicare tax, that's imposed on everybody. And under the proposal, that's being raised to 5%. So that's a significant increase in those taxes as well. And that's on top of the regular ordinary income tax of 39.6 and not including state taxes. So the tax burden can start to really buckle up to about 66%. When you get tax burdens that are that high, they become confiscatory. People don't sell assets, people don't sell property, people try to find any way possible to mitigate tax. I'm not so sure the government collects more tax, but then they have to hire 87,000 more IRS agents to enforce it.
Right.
And it becomes cyclical and everybody hates the government. And then they change it to the more friendly IRS. I think we won't see some of these proposals, but we will see some. But there is one that I'm pretty sure we will see. So right now there's a disparity. So if if you have a limited liability company or a limited partnership, um, or especially a limited liability company, um, eh, when you receive a distribution from that LLC, more likely than not, it is subject to um, Medicare tax and it is subject to FICA tax. But due to a quirk in the law, for those people that are operating as an S corporation, the distributable net income above their salaries is not subject to Medicare tax and not subject to FICA tax unless the IRS forces them to increase their wage base. So there's a disparity between the two. Under the proposal that we have now, um, all of the distributable income from any source of business, S corporations, trusts, partnerships, LLCs, will all be subject to the FICA tax
Hmm.
and the Medicare tax.
Hmm.
So they want to make that go away.
Yep.
For those of our clients that are in the business of venture capital, they're in the business of real estate development. Um, they run funds. One of the things that they get as a benefit of doing that is something which is called a carried interest. And what a carried interest is if I'm a promoter of real estate and I have 10 buildings and I'm syndicating that and people are investing in my real estate fund, I can have a carried interest, meaning that they'll carry me for 2 or 3% or 4% of the profit. So when those
Right.
buildings sell, I will get my 4% of the profit. And under the current law, that's pretty much taxed as capital gains rates to me, as if I was an investor rather than the dealer or it's my business in doing it.
Right. Right.
And under the new proposed rules that are available, um, all of those types of structures will now be considered ordinary income. So all carried interest would be taxed as ordinary income. That pretty much almost made it into law last time. There's a good chance that can happen. The lobby is strong for that. So I want that to be known.
Harry, what's the action item people
Uh,
should be doing now?
well, I think the action item now is the way that instead of having a carried interest, we can have those other interests being held by trusts for the benefit of them. And I want to think about all the things that we need to do. Remember, these proposals were just released a couple of weeks ago. I
Yeah.
wanted to get out to everybody right away with what's going on. But here's a big one. Uh, the administration has proposed to repeal 1031 exchanges in real property.
Oh, right. Yep.
Yeah.
Yep.
So they're saying, no, no, no 1031 exchanges. You know, whether if you exchange it or you sell it, you're going to pay the tax on it. So that's a big one. I'm not so sure that'll pass. 1031 exchanges have been around for a while,
Huge. Yeah.
but it's
Huge
here.
area.
They're also going to propose depreciation recapture. So there's depreciation recapture whenever we take depreciation for the sale of every kind of asset other than real estate. Real estate has been favored, but under the proposed rules, uh, depreciation recapture will be taxed even for real estate. But here we go with something that I find understand that they're proposing tremendous limitations in the conversion of any retirement plan to a Roth plan. But years ago, I was told by a colleague of mine, just wait and see. The government is going to come after your retirement plans. You're working your butt off, setting up 401ks and pension plans and IRAs and Roth IRAs. And so here they are. So they're basically now saying that if you have more than $10 million worth of assets in your retirement plans, so you've done a good job. All right. You followed the rules. You built a retirement plan, and that retirement plan, you've made good choices and good investments, is now worth more than $10 million. Effective with the new law that they want to propose, it'll be effective for tax years after December 31st, 2023. If you have $10 million or more in your retirement, you're going to be forced to distribute 50% of the excess to yourself and pay tax on it. So if you have a $20 million retirement plan, as some people do, they've been very fortunate, worked very, very hard, then you would have to distribute 50% of the excess over 10 million. So that would be $5 million, and you'd have to pay full ordinary state income tax on that $5 million. So basically, they encourage you to set up retirement plans, and now they're discouraging you by forcing you to do that. And if you have over $20 million in a retirement plan, they are going to require you to basically cash in your Roth IRAs and your Roth accounts, and not be able to keep those any longer. So, there are a bunch of other minor changes that are coming along the way. Some fiduciary changes with regards to IRAs and others. And they're also looking to extend statute of limitations so the IRS can look at everything longer and further. So those are, if there's not enough, the most of the major proposals. Maybe 1 or 2 will get enacted. Maybe 10 will get enacted. Maybe none will get enacted. So once again in America, all eyes will be on the next election, because the next election does have consequences, and those consequences are such that they can affect what they do. Again, I repeat, I'd like very, very much to take the opportunity to visit with everybody, see what we can do today to lock in the favorable tax environment on all of these different fronts and all these different plannings. I think it's really worthwhile. And with that, if there are any questions, I'll take them. If not, I think I accomplished everything that I wanted to do in getting this information out to everybody.
Yeah, there were a couple questions. You mentioned the 1031 exchange. We got that covered. And then I think regarding depreciation recapture is now at 25%. So if change, it will be at income tax rates. Is that correct?
That's correct.
Yeah, good questions. Thank you. Thank you, Eugene. Thank you, everybody, for being here. Again, the link in the chat there, copy that, get with us complimentary on any questions at all. Happy to give you input. And we're also going to get this replay out to everybody that signed up. So look for your email for the replay so you can go back and watch it and get reminded. Thank you, Harry. Great stuff as always.
Thank you, Paul. Thank you, everybody. Have a great day. Bye-bye.
Okay. Bye-bye.